this week's market update. Domestic politics snatches Brexit defeat from the jaws of victory. There's good news and bad for President Trump. OPEC gives a fillip to the oil price, and the Fed prepares for its next interest rate hike. The big political story of the week at home is in no doubt. Britain's tortuous Brexit negotiations. It's been a dramatic few days. Britain seemed to be moving one crucial step closer to unlocking trade talks with the rest of the EU on Monday, only for the government's DUP supporters in Northern Ireland to scupper the deal. As ever, domestic politics has got in the way of an international solution. A key compromise agreement between London and Dublin on the border between Ireland and Northern Ireland had been agreed, but the Unionist Party, through which the government holds on to its wafer-thin majority, refused to give its backing to a deal. It sees the Anglo-Irish deal as a step towards a unified Ireland and breakup of the Union in all but name. Earlier in the day, as Theresa May headed to Brussels in search of EU agreement to move on from divorce talks to trade negotiations, things had looked more encouraging. After much wrangling and posturing by both sides, it was agreed that Ireland and Northern Ireland would maintain what the diplomats agreed to call regulatory alignment on either side of the border. The wording gave enough to meet Dublin's concerns about the reimposition of a hard border, which would of course be an unwelcome reminder of the pre-Good Friday troubles. It was, however, not so loose as to raise objections in London. A previous formulation had referred to no regulatory divergence, which left open the possibility of Northern Ireland accepting the rules of the single market and customs union, effectively cutting off Northern Ireland from the rest of the UK and creating a new trade border in the Irish Sea. The agreement looked like the final key to unlocking full trade talks, which the EU had insisted were dependent on the resolution of three issues: the Irish border question, the future rights of EU citizens in the UK, and a settlement of Britain's outstanding financial obligations to the other member states for pensions, building projects and the like. But for the DUP, the distinction between regulatory alignment and no regulatory divergence was too subtle. The battle to find a solution continues, and the issue looks as intractable as ever. If Northern Ireland is not in the single market and customs union, a hard border looks unavoidable. If it does enjoy those benefits and effectively splits from the UK in the key area of trade, it's hard to see how the government can remain in power without the support of the DUP. Giving Northern Ireland special treatment also opens up the question of whether other Remain voting areas like Scotland and London should also qualify for a carve-out. So the next key dates are December the 14th and 15th, when the EU is due to provide its final decision on whether sufficient progress has been made on these three issues to begin trade talks. The financial markets were volatile as this drama in Brussels unfolded. The pound initially jumped on the announcement, rising by nearly 0.5% to over $1.35. Against the euro, the pound was even stronger, up 0.75% at €1.14. The bond market also reacted to the news, with the yield on 10-year gilts rising a little to 1.28% as investors bet that a more successful Brexit outcome would be a positive for economic growth and so lead to higher interest rates in due course. However, once news emerged that the DUP had scuppered the deal, the pound fell back again to under $1.35. Over the Atlantic, it's been a mixed week for President Trump. On the key issue of tax reforms, there was good news in the early hours of Saturday morning after proposals to reduce corporate and individual tax rates scraped through the Senate, an important hurdle on the road to new legislation. Just getting this far is a major achievement for the White House, which has had to overcome serious opposition from both Democrats and Republicans. For the opposition Democrats, the tax cuts are seen as a sop to big business and the wealthiest people in society. But for many Republicans too, the prospect of a fiscal easing that could see US debt balloon in the years to come is also anathema. The White House's line is that, as in the Reagan years, tax cuts will lead to higher growth, and that will therefore they will be self-funding. There's widespread skepticism about whether tax cuts will actually lead to anything other than money that companies have parked overseas returning to the US and being handed out to shareholders in the form of share buybacks and special dividends. With the US economy already nearly 10 years into a recovery and US end demand fairly anemic, there's little incentive for companies to do anything else with the money. Why invest at the top of the cycle when you can simply use the money to boost your share price at much less risk? And this, of course, is why the stock market has reacted so positively to the prospect of the tax reforms. Even despite the escalation at the end of the week of Washington's contentious Russia investigation, the S&P 500 ended last week 1.25% higher. Before revelations about former National Security Advisor Michael Flynn's lies to the FBI about contacts with Moscow, the US benchmark was actually on track for its best weekly gain in a year. And this week, the market also opened strongly again, with the S&P 500 rising another 0.5% at yesterday's opening. Now, analysts believe that the markets are still only pricing in a 50-50 chance of tax reforms actually being enacted, so the potential remains for a further uplift if talks on merging still separate bills passing through the House of Representatives and the Senate are successful. The biggest winners of the tax reforms are expected to be smaller and medium-sized companies, which have a bias to domestic earnings and so tend to pay a higher effective tax rate. Companies like this could see a fall from an average 31% to 20%. Richer individuals with sizable portfolios of shares also stand to be big gainers. So far this year, the S&P 500 has risen by 18%, while the Dow Jones Industrials Index is up 22%. Now, the Flynn affair is the cloud surrounding the tax reform silver lining, if you like, for the president. Shares fell by 1% on Friday after it emerged that Mr. Flynn, a former general, has struck a deal with federal investigators who are probing alleged collusion with Moscow by the Trump team in the run-up to last year's presidential election. Flynn is the first person to be charged by Robert Mueller. He's the special counsel heading the probe, and he is thought to be working with the investigation in a bid to reduce any sentence that he might receive. That could potentially bring other senior White House figures, perhaps right the way to the president himself, into the spotlight. In time-honoured fashion, the president lashed out on Twitter. He described the probe as a witch hunt. But the president's critics said that Flynn's guilty plea shows that the Trump team were conducting their own foreign policy in contradiction of the US's official position before he took office and after it had been announced that Russia had interfered in the election process. Now, in the run-up to the traditionally quiet Christmas period, investors have plenty to keep an eye on in addition to Brexit, tax reforms and the Russia probe. Top of the agenda will be next week's Federal Reserve meeting, at which it is considered almost certain that interest rates will rise by another quarter point. According to the Fed's most recent meeting minutes, the US Central Bank expects to raise rates once more this year and then by another 3 quarter-point increments in 2018. Now, that's not how the markets see things, with Fed fund futures indicating just a 20% chance of that trajectory. The so-called yield curve, which shows expectations of rate hikes into the future, is flattening, and that implies that investors are growing concerned about the economy further out and are expecting weaker inflation to come. If the market is right, the Fed will be most likely more cautious about rate rises. The counter-argument is that if the Trump administration is successful in pushing through tax reforms, the Fed may decide that higher potential growth justifies a more rapid rate of interest rate hikes. A second area of focus in the weeks ahead will be the oil price, after last week's agreement by OPEC and Russia to keep a lid on production throughout 2018, in a bid to limit global stockpiles and put a floor under the price of crude. After weeks of debate, the world's leading producers decided to extend production cuts beyond March's deadline. A 9-month extension of the deal to the end of the year pushed the cost of Brent crude up by more than 2% to over $64 a barrel. The positive glow has faded a bit this week as investors question the sustainability of the agreement. The outlook for oil now hinges on the discipline with which OPEC and Russia can enforce next year's production cuts and the speed with which North American shale producers move to fill the gap at today's more profitable oil price. And meanwhile, Bitcoin continues to be the most popular speculative trade after the cryptocurrency hit another new record of $11,800, having been priced at less than $2,000 in April. Two of Chicago's largest derivatives exchanges this week said that they would start trading Bitcoin futures contracts as they attempt to cash in on rising interest from institutional as well as private investors. Bitcoin and its rival cryptocurrencies continue to divide the financial world. Some investors have made life-changing fortunes from well-timed speculations, but others remain convinced that the surge in price is a bubble just waiting to pop. When or if that happens, as it inevitably must if the history of speculative manias is any guide, others will make life-changing losses as well.